Hello everyone, I hope so you will be fine. So guys, we are discussing this CMA part 2 corporate finance section. And in this section, corporate finance section is 20% of your exam. And in this section, we have total 5 units. We have a unit number 4, 5, 6, 7, and 8. So these 5 units are 20% of your exam. And we are into unit 4. Okay. And in unit 4, we have these topics. So the name of unit 4 is types of securities. And in this unit, we have first topic, which is relevant to the bonds, and second topic, which is relevant to the stocks, and third topic, which is relevant to the dividends. So we are discussing today stocks, like what are the stocks? Here we go. So guys, first of all, we need to understand, because as we know, we have two types of stocks, okay? Two types mainly. So the first type is called what? Common stock. Stocks mean to say share. And second type is called what? Preferred stock. So starting with the common stock. So here we go. Please remember, guys, common stockholders, they are considered as owner of the corporation, right? So why they are called owner? Because these peoples are having voting rights. So voting right mean to say they have a right to select the board of directors. They can also cast their vote on different resolution. For example, in case of merger, acquisition, or maybe in setting the salaries of the board of directors. So in different matters, so the common stockholders, they can cast their vote. Okay. So, and they are also considered the owner of the corporation. And also remember the second point, it's also very important. So common stocks are usually irredeemable from company point of view. What does mean by irredeemable? Irredeemable mean to say if these stocks are issued by the company, okay, and there is no repayment date is mentioned on the stock, that for example after 6 years or 10 years company will buy back. No. So these are irredeemable from company point of view. So once these stocks are in issue,
ये
forever
क्या
these
रहा
stocks are in issue.
मैंने आप
And the next point is whatever dividend we are paying on the common stock, this amount of dividend is not a legal commitment. Like it is not like a fixed, like an interest. So it is actually the discretion of the board of directors how much dividend they want to pay. So they can pay less dividend or even more dividend. It's a totally choice of the board of directors. And also remember, please, whenever dividend is paid, so first we always pay dividend to the preferred stockholders, and then we pay to the common stockholders. And similar way, in case of liquidation mean to say when we dissolve the business, we sell the assets of the business and we settle the liabilities. So in case of liquidation, so what we do, whatever proceed we get through the sale of asset, first we use that proceed to pay to the debt holders, and if anything is left, then it will be paid to the preferred shareholders, and if anything is left, then it will be paid to the common shareholders. Understood? So this is the reason the common stockholders are considered more riskier investment, or they are considered on the risky side. Okay, because they are at the bottom in case of liquidation, right or wrong? And also this investment is considered more risky because there is no guaranteed return. Okay, and they are also last in priority in a liquidation. And also, please, we have other points now. We are discussing here what are the advantages of the common stock to the issuers. Issuer mean to say the company who is issuing the common stock. So first advantage is common stock does not require a fixed dividend. As I told you, the amount of dividend is not a legal commitment like interest. It's totally the choice of director, whatever the amount they want to pay. They can pay higher dividend or even less dividend. Okay. So, and that is why So the common stock doesn't require a fixed dividend. This is the first advantage to the company. Second advantage, there is no fixed maturity date for the repayment of capital. As I told you, common stocks are irredeemable. As an investor, if you invest in the common stock and if you wish to sell those stocks, you cannot force the company to buy back. No. So you have to find another investor and you can sell your stocks to him. So then the sale of common stock increases the credit worthiness of the firm by providing more equity. So because guys, we know when we calculate the leverage ratio, we also take debt divided by equity ratio, right? So this ratio we use to measure the risk. So when we issue the common stock, obviously it will increase your equity. So due to that, your leverage will reduce or your gearing will reduce, right? So it means, so whenever we issue the common stock, it reduces the risk of gearing. Then we have other advantages also. What other advantages? So obviously, even the dividend is not a legal commitment or it is not a fixed commitment. Still, there is advantage to the investors also because these stocks grows in value, right? As the firm succeed, right? So this is what is the advantage to the uh, stockholder actually, right? And this advantage can also be availed by the company. For example, when let's assume when we started a company, at that time price was $22. Let's assume the price was only $2. Now, for example, after 5 years, now stock price is $100, right? Let's assume, I'm just assuming. Okay, now if company will issue the stock, obviously they will issue the stock at $100. So it means they can get more money by issuing less stock. So this is the advantage to the company also. Then we have certain disadvantages to the issuer first. Okay, like what is the disadvantage to the issuer? Number one, the cash dividend on common stock are not tax deductible. This is really important point because when you compare with the debt, right? With the debt, on debt, we always pay the interest. And this interest is our expense. And this expense we can record as expense in our tax returns. Okay. Tax returns means the documents which we file with the tax authorities to pay the corporation tax. So this interest expense can be recorded as a expense in the tax return, which will reduce your taxable profit. Obviously, once your expenses will increase, so your taxable income will reduce, right? And if your taxable income is reducing, obviously you have to pay less tax. That is why we say interest expense is tax deductible, but this is not the case with the dividend. So whatever cash dividend we are paying on common stock, even on the preferred stock, whatever dividend you will pay. So this dividend is never tax deductible. You cannot record as a dividend expense in your tax returns. Understood? So the other logic is why it's not a tax deductible, because it is always, this dividend is always paid out of after tax profits. After tax profits, we have a profit before tax in our income statement, then we deduct tax expense. This is called profit after tax or net income. From here we pay the dividend, right? So that is why there is no tax deduction available to the company. So second disadvantage is because whenever we issue the common stock blindly, so we know the common stock has voting right. So what is the risk here? So the voting rights, okay, may dilute as more common stock is sold. Obviously, if you will issue blindly stock, the common stock, so the voting rights may reduce, right, to the existing shareholders if they are not buying. So this, due to this reason, you may lose the control also. You stand for shareholder, whoever is controlling the firm, so he may lose the control as well. Okay, then what is the other disadvantage? So new common stock sales also dilute earning per share. EPS formula we studied. So we always take net income minus preferred dividend divided by weighted average number of outstanding weighted average number of common stock. We need number of common stock, weighted average. Okay, and obviously if you are issuing the stock, it will increase the denominator of the formula, so which would result in in reduction of EPS, right? So your EPS will reduce. So earning per share, if obviously if EPS will go down, it may affect the stock prices also. Understood? So then what? So other disadvantage is, so we there are certain underwriting costs. So usually underwriting costs are typically higher for common stock, and it is less for example, maybe the bonds and for the preferred stock, but it is usually higher for the common stock. What are underwriting costs? Maybe you have idea about this, because usually when we sell our stocks, we sell through the bank. Sometimes banks, they may buy our 100% stocks and then they can issue to the public. But this arrangement obviously will secure the company, because company will get finance for 100% sale of shares. Now risk is transferred to the bank, because he will sell the stock to the public now, and due to that reason bank will charge a commission, usually higher commission from the common stock if there are any underwriting deals are there. Okay, so then too much equity may raise average cost of capital of the firm above its optimal level. Actually, what is cost of capital, we'll see in the future lectures. But sometime, obviously, if you are issuing equity or common stock, it may raise the cost of capital beyond the optimal level. Okay, so these are the disadvantages. So now we have a note here. What is the note? Common shareholders ordinarily have preemptive rights. So what are the preemptive rights? So now first let me explain. Preemptive, actually it's a right which we give to the existing common shareholders. This is the right which is given to the existing common shareholders. And this right is for what? This right is for to purchase any additional stock issuance in proportion to their current ownership percentage. So what it means? It means whenever company will issue the new stock, okay, first we will issue to the existing shareholders, and if they will not buy, then we can issue to the others or to the public, right? So actually preemptive right give common shareholders the right to purchase any additional stock issuance in proportion to their current ownership percentage. What is the advantage of preemptive right? Obviously, if existing shareholders will buy the new stock which is issued by the company, so their voting rights will not be affected. But if they will not buy the stock, so their voting rights may reduce. Okay, then also remember, please, sometime we also issue a certificate or warrant with the stock. So what is warrant? So warrant actually is an option to buy certain number of shares at fixed price. So this is what is warrant. So these all points are relevant to the common stock, okay, or to the common shares. So now we have other types here. Then we'll see some couple of questions so you can get the idea how question will be discussed. So now here, guys, we are discussing second types of share, which is called preferred stock. So please remember, so preferred stock, first thing I'm going to tell you, first point I'm going to explain. Usually preferred stocks have no voting rights. Okay, so because common shareholders have voting rights, so they can participate in the decision making, but the preferred stockholders, they don't have voting rights, they cannot participate in the decision making, like in the selection of board of directors, etc. Second point which I want to tell you, so the preferred stocks might be redeemable also, or it might be what? Irredeemable also. Redeemable means like a loan. For example, today if we are issuing the stock, so we will tell preferred stock. So we will tell to the investors maybe after 5 years or 10 years. So we will buy these stocks back and we will return their capital. So this is redeemable. And obviously if up to that 5 years or 10 years, we'll also pay the dividend. But please remember, dividend is not a legal commitment here. So that I'll explain a little bit later. So then what are the irredeemable preferred stocks? Irredeemable means say like a common stock. If the company is issuing the preferred stocks, and if preferred stocks are irredeemable, so we will not buy it back from the investors. And if investors want to sell these stocks, they have to sell to the potential investors. And other point, please remember, so here the dividend payment is not a legal obligation. It's not a legal, because legal mean to say it is not a contractual obligation until unless it is declared. If you will declare, then you have to pay, right? So, but it is not a legal obligation. Sometimes they may ask the question in your exam, okay, and they may ask you to identify the statement which is correct or incorrect, and they can include this point. So please remember, so the whatever dividend we are paying on the preferred stock, it is not a legal obligation of the company until unless it is declared by the business, okay, or declared by the company. And please also remember, so usually preferred stocks yield to an investor is usually higher. So yield to an investor means a yield stand for return. Why return on preferred stock is higher? Why company is paying more return on the preferred stockholders, okay, as compared to the debt holders? I'm just comparing, as I told you guys previously. So whenever, for example, even in case of liquidation, first we sell the assets of the business. So first payment will be made to the debt holders, then payments will be made to the preferred stockholders, and then payments will be made to the common stockholders. So please remember here, when you compare the preferred stocks with the bonds, because debt holder means maybe bond holders, okay? So bonds we will discuss. So when we compare the preferred stocks and the bonds, so company always pay a high return. High return means a high yield on preferred stockholder, because these investments are considered more risky than debt holders. Reason, because mostly debt is secured, right? Bonds are secured and they have priority in case of liquidation also. Even in case of normal return payments. So first we will pay interest to the debt holders, then we'll pay the dividend to the preferred stockholders, and then we will pay the dividend to the common stakeholders. So when you compare preferred stock with the debt holders or with the bond holders, so on preferred stock we always pay high return because this is more risky and company pays risk premium to the investor. So this is the other point. So please remember, preferred stock yields to an investor is usually higher than that of a bond from the same issuer, okay, as I told you, because preferred stocks are more risky investments. This point I have already explained, that preferred shareholders have a higher priority in bankruptcy also than common shareholders, but lower priority than debt holders. I told you already, first payments will be made to the debt holder in case of liquidation. Then payments will be made to the preferred stockholders and then to the common shareholders. Now we are discussing here some typical provisions, general provisions related to the preferred stock. So first point, if the firm goes bankrupt, we have already discussed, the preferred shareholders have priority over common shareholders in assets, because assets will be sold, first payment will be made to the debt holders, then preferred shareholders, then to the common shareholders. So this is that typical provision. Second, if preferred dividend are cumulative. So let me guys explain, because sometimes preferred stocks or dividend on the preferred stocks might be cumulative, or sometimes it might be what? Non-cumulative. Okay, so cumulative is also called dividend in arrears also. Please remember. Okay, dividend in arrears. So please guys, we need to understand here. For example, this is year one, this is year two. And if you're dealing with a non-cumulative preferred stock, for example, due to any reason, so company has not paid any dividend on preferred stocks in year one. So there is no dividend. In year two, whenever, for example, if company will pay the dividend, company will pay dividend only on year two. Okay, not for year one. But if preferred stocks are cumulative, if in year one, you were unable to pay dividend, for example, you didn't pay, but in year two, whenever you will pay dividend even to the common shareholders, before the payment to the common shareholder, first we will pay the dividend of year one of preferred stocks, then for year two of preferred stock, it will accumulate like interest, right? So this is what is the cumulative preferred stock, right? So cumulative means if dividend is unpaid next year, previous dividend will also be paid, current year dividend will also be paid, okay? And then we will make dividend payments to the common shareholder. But if it is a non-cumulative, if you have not paid dividend in year one, in year two, if you will pay only year two dividend. Understood? This is what is non-cumulative. So this is what is the second point they're telling you. If preferred dividends are cumulative, so dividend in arrears, because cumulative dividend is also a dividend in arrears, must be paid before any common dividends can be paid. Like you have to pay the dividend in arrears first, then you can pay to the common shareholders. Next point, preferred stocks may participate with common stock in excess earning of the company. Like actually these kind of preferred stocks is called participative preferred stock. Okay, participative means, for example, maybe we are committed that we will pay 8 for example percent dividend also. Okay, let's assume, so we have issued the preferred stocks and we told, let's assume these preferred stock is having x percentage of dividend, will pay that dividend also. But if company will earn, excessive profits, then what will happen? So the preferred stockholders can also participate in the excessive earnings. Understood? So this is what they are trying to tell you here. So for example, 8% preferred stock might pay a dividend each year greater than 8% when corporation is extremely profitable. So it means here 8% is the amount of dividend which we will pay. But if company is earning higher profit, so maybe we can share some profit with the preferred stockholder. So this type of preferred stock is called participative preferred stocks. So you should remember, so preferred stocks could be redeemable also. It could be irredeemable also. It could be cumulative also, non-cumulative also, participative also. And please make sure that dividend payment is not a legal obligation, even on the preferred stock until unless it is declared. Then we have a next question. We know each stock is having a par value, even the common stock or the preferred stock, they have a par value. Par value is also called face value. So face value actually it is a liquidation value and it is a percentage of par equals the preferred dividend. So what does mean by this statement? Because whenever you calculate the amount of dividend on preferred stock, so you always take percentage of dividend multiplied by par value. Okay. For example, he told you in the exam question, 8% preferred stock. Okay. Par value for each preferred stock is $100. Let's assume. So it means if you want to calculate the amount of dividend on preferred stock, so we need a par value which is $100 into 8%. This percentage is actually for the dividend. So $8 is the amount of dividend per preferred stock. Okay. So if you want to calculate total amount of dividend, simply you can multiply this dividend per share with the number of stocks to get total preferred dividend. This is what they are trying to tell you here. So whenever we calculate dividend, we always take percentage of the par value. Okay, so now guys here, please remember here, so there's a one term which is called transient preferred stock. Actually, these preferred stocks are redeemable and these preferred stocks are redeemable within short period. Short period means it could be any period between 5 to 10 years. So this is called transient preferred stocks. Simply these preferred stocks are redeemable. Okay, like a loan, we have to return their capital. Okay, and I have already told you, so there are no voting rights on the preferred stock. You should remember no voting rights. This point whenever you're tackling the question, okay? So now guys, here we have some retirement provisions for the preferred stock. Number one, because please remember, sometimes companies may issue convertible preferred stocks, okay? Convertible means say if today you are issuing preferred stock, you may give the option to the stockholders that these preferred stocks can be converted into common stock. Okay, this option is always with the shareholders, and you will also give conversion ratio also. Like for let's assume for each preferred stock, how many number of common shares you will issue. So this is what is called convertible preferred stock. If this option is there, so that is called convertible preferred stock. Okay. So then sometime we may have a call provision on the preferred stocks also. Call provision is what? For example, let's assume preferred stock is having preferred stocks are redeemable and having a maturity life of let's assume 10 years. So what is call provision? Call provision mean to say, so maybe the issuer, the company who is issuing the preferred stock, he may call these stocks, for example, maybe after any X number of years. Let's assume it is written in the terms and condition that the stocks may be callable, okay, callable anytime after certain number of years. For example, maybe after 10 years or after 5 years or maybe after 6 years. So company can call it back, but company will pay call premium. Call premium means some extra amount over and above the par value. Okay, that is call provision. Okay, this is what is written here. The issuer may have the right to repurchase, means so we can buy back the stock through a call provision. For example, the stock may be non-callable for a stated period. For example, for 5 years, you cannot call it back. But after this 5 years, it may be called if issuers pays a call premium. Call premium means some extra amount over and above the par value. So now we have some advantages here. First advantage to the issuers we are discussing first. So first advantage is it is a form of equity and therefore builds the credit worthiness of the firm. So guys, usually we can say it is a part of equity, but in certain ratios, please make sure we consider preferred stock as a part of debt, right? So mostly in ratios, for example, if you are calculating leverage ratio, so we take preferred stocks as a part of debt. But in certain ratios, we can also take as a part of equity. So let me give you example. For example, if preferred stocks are redeemable and these preferred stocks are cumulative. Redeemable, it's like a loan. Cumulative, because any interest which is unpaid, you have to pay, right? So this is the features of debt. Okay, and in that scenario, mostly in balance sheet, we will write preferred stock under liability section. But if preferred stocks are irredeemable and non-cumulative, so both features are for equity. Okay, so then we can write under the equity. So here, what is the first advantage? It is the form of equity. Let's see, if preferred stocks are irredeemable or non-cumulative, then it is a form of equity, therefore builds the credit worthiness of the firm. Okay. Second, control is still held by common shareholders, because even you are issuing the preferred stocks blindly, so it has no voting rights, so you will never lose the control. Then what? Superior earnings of the firm are usually still reserved for the common shareholders, because mainly guys, we pay first return to the debt holders, then to the preferred stockholders, and whatever we have a legal commitment for debt, that we will pay, and whatever we will declare for the preferred stock, or if you have any X percentage on the preferred stock, only that amount we will pay. Whatever is remaining, that is still whatever is remaining. For example, any reserve which is remaining after making the payment of interest on debt and dividend on preferred stock, whatever is left, that is for common shareholders. So that can be a huge amount. Then we have a disadvantage to the issuers. So number one, whatever cash disadvantage we are discussing now to the company, whatever cash dividend we are paying on the preferred stock, please remember this is not tax deductible. So because this dividend payment you cannot record as a dividend expense. No, you cannot record because this dividend is paid, okay, after tax profit, and this you cannot record as a expense. So you will not get any tax benefit on the cash dividend which we are paying to the preferred stockholder. Understood? Then in period of economic difficulty, for example, if there are depression or crisis, accumulated unpaid dividend, which is also called accumulated, means cumulative dividend, which is unpaid of the last year, unpaid amount of dividend of the last year is called accumulated. Unpaid dividend, it is also called dividend in arrears. So may create a major, okay, managerial or financial problems to the firm, because if you have not paid dividend for the last year and maybe in this year still you are into the losses, so but you have to pay that amount of dividends, it can create a financial difficulty for the company or for the issuer. So this is the disadvantage to the issue. So here we have a note, guys. So sometime, please, this note is from another point of view. For example, if as a company you invest into common stock of other related companies, or if you invest in preferred stock, okay, of other related company, obviously in this investment, so you will receive dividend, right? We will receive what? Dividend we will receive actually, right? So please remember here. So what is the point here? As per US tax law, almost 70% of this dividend, 70% of this dividend, even of common stock or of preferred stock, which you are receiving on your investment. So this is tax, you can say deductible. Tax deductible mean to say you need not to pay tax on this. Maybe on the remaining 30%, you will pay tax. Understood? But on the other hand, if you invest in the bonds, of other company, and obviously on this bond you will receive interest. So please remember, this interest received is considered as your taxable income, and you have to pay tax on 100% trust income. But for dividend, if you're receiving dividend, so 70% is deductible. Okay, this is from investor point of view. Now guys, here we are discussing some couple of questions. So here we go. First question is on your screen. And what is the question, guys? Please remember, they're saying which one of the following rights is ordinarily sacrificed by the holders of the preferred stock in exchange for other preferences received over the common stock. So we have to understand first question. Actually, usually we know preferred stockholders, they have preferences over the common shareholders. Which kind of preferences? Like for example, they are receiving dividend in priority. They are receiving assets value in case of liquidation in priority to the common shareholders. So they have preferences. But so which of the following right is ordinarily sacrificed by the preferred stockholders? Simply you have to tell what is the disadvantage of preferred stockholders. Okay, or what is the, what are the benefits they are losing actually being a preferred stockholders. On the other hand, you have certain preferences, but here they're asking the right which is ordinarily sacrificed by the preferred stockholders. Okay, or what you lose as a preferred stockholders. You have priority in other cases, but you lose something also. So we have to tell that option, like what you sacrifice being a preferred stockholder. So number one option, first option is the right to vote for members of the board of directors and in other matters requiring a vote. Actually, the right to vote for members of the board, actually this you will sacrifice because you don't have a voting rights. So actually this is the answer. Because you will not have a voting rights. So voting rights you will sacrifice being a preferred stockholder. This is the answer of the question. Now we have to check why other options are not the correct answer. The right to accrue dividend payments in areas when payments are not made for the period of time. So this you don't sacrifice, guys. You don't sacrifice. Actually, you have a right. For example, if you have a cumulative preferred stocks and dividend is not paid in the last year, so that will be accumulated and company has to pay in the current year, right? So this you don't sacrifice. Actually, this you have, this right you have. So this is not the answer of the question. The answer is what you sacrifice. This you don't sacrifice. You have this right. Then next, the right to share in the residual assets of the company upon liquidation. This right you also have. You don't sacrifice. You don't sacrifice. You have a right because whenever company liquidates and we sell the assets of the firm, first payments will be made to the debt holders, then to the preferred stockholders, then to the common stockholders. So this right you have. You can participate in the residual assets of the companies upon liquidation. You don't sacrifice this. This is not the answer. Okay, this is not the answer. Then the right to share in periodic earnings of the company through receipts of dividend. Actually, point D, they're saying the right to share in periodic earnings of the company through the receipts of dividend. Yes, we receive a dividend, right? Because preferred stockholders receive their dividends before the common stockholder receive theirs, right? So that is why this right you also have. We receive, so you don't sacrifice. You sacrifice only voting rights. So this is the answer of the question. Then you have other question. So they're saying following except was taken from the company's financial statements. So 10% convertible participating dash dash dash, right? So 10% convertible participating. I told you preferred stocks are participative, right? Participator mean to say they will receive the dividend plus they will participate in the company's earning, especially if company is earning high profit, right? So the question is the following excerpt was taken from the company's financial statement. 10% convertible participating dash 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 $10 million. What is most likely being referred to here? Like What word you will write? Obviously, participative are the preferred stock, not the bonds, not the stock options, not the common stocks. Okay. Great. We have one more question on your screen. So guys, which one of the following describes a disadvantage to a firm that issues preferred stock? Simply you have to tell what is the disadvantage to the issuer. The company who is issuing the preferred stock, what is the disadvantage to that? Number one, preferred stocks typically has no maturity date. Is it advantage or disadvantage? It is actually it is the advantage now if preferred stocks are irredeemable. Okay. It is the advantage to the business because company has not to pay any amount of capital back to the shareholders. So this is the advantage. But the question is, what is the disadvantage? Okay, then what B? Preferred stock is usually sold on higher yield basis than bond. Yes, this is the loss to the company because preferred stocks are risky investment as compared to the bonds, right? And that is why company has to pay some extra risk premium to compensate their risk. So actually, this is the disadvantage to the firm. This is the answer of question because company has to pay high return as compared to the bonds on the preferred stock. And if you're paying high return, this is loss to the business and this is the disadvantage. So this is the answer of question. Then next, most preferred stock is owned by corporate investor. It is not advantage or disadvantage. So anyone can buy. Then preferred stocks dividend are legal obligation. No, it's not a legal obligation until unless it is declared. I told you at the start, right? I told you no dividend even on cumulative preferred stocks are legal. Even preferred stocks are cumulative. Still, it is not a legal obligation of the corporation until they are declared. So option is the B option, right? Not the D, not the C. Then guys, we have a next question on your screen. So here we go. So they're saying the equal, let's have a look first of the requirement. So where is the requirement? So here we have a requirement. They're saying common shareholders have preemptive rights. Okay. If an additional 400,000 shares of common stocks are issued at $6 per share, like you are issuing additional 400,000 shares, right? A current holder of 20,000 shares of common stock must be given the option to buy. So maybe now we have to look for the question actually. The question simply, they are saying if company is issuing 400,000 additional shares, right, at $6. So if let's assume there is a investor who owns 20,000 shares, how much shares will be given to the owner of 20,000 shares? How much new shares you will give? How much additional shares you will give to the owner of 20,000 shares? For this, we have to read the question. Now, here we go. They're saying equity section, because question is about common stock. Okay. So the equity section of statement of financial position is presented below. So what's the equity section? They told you preferred stock. Question is not about preferred stock. Question is about common stocks. Okay. Common stocks. So then we have a common stock, $5 par value. Okay. Then we have a paid in capital excess for the par. Then we have a retained earnings, and then we have a net worth. Okay. So guys, please remember, first we have to calculate number of shares for the common stock. So this is the dollar value of the common shares, right? We know this is the total par value, right? We know this is the total par value of the common shares. And total par value, how you calculate? We need number of shares multiply by par value per share equals total par value. So total par value is given here 10 million. 10 million. Okay. So par value per share is also given here $5. It means how many number of shares should be here. This is the missing figure. How you will calculate? So you can just take total par value divided by $5, right? So you will get how much? 10 million divided by 5. Can you just work 10 million divided by 5? So it means 2 million number of shares you have already in issue. Already in issue. Already in issue. Now you have to find out how many additional shares you are giving. You are giving 400,000 shares. We are giving additional 400,000 shares to existing 2 million shareholders. So now we can simply calculate the percentage. We can calculate the percentage for now. Then we'll see the requirement of the question. Now calculate the percentage of new issue. New issue. So new issue shares how much? 400,000 shares. We are issuing to the existing shareholder, which is 2 million. And if you will convert into percentage, I believe it is going to be 20%, right? So it means we are issuing new additional shares, which are 400,000. These 400,000 is the 20% of existing shares. Now 20%. Now we have a requirement. What's the requirement now? So they're saying there is a holder who owned 20,000 shares of common stock. How much shares we have to give, okay, to this shareholders? Obviously 20%, because we issue new shares, which is 20,000, 20% shares of the existing shareholders, right? And now if you have a existing shareholder which who owns 20,000 shares, we will simply give 20%. Simply give 20%. So if you will take 20%, that is going to be how much? 4,000. Just recheck, guys. 4,000 shares, right? So it means 4,000 new shares will be given to the shareholder who owns 20,000 shares. Okay, so option A is the correct answer. We have another question on your screen. So they are telling you which one of the following statement is correct regarding the effect preferred stock has on company. Like you have to tell which is the correct statement regarding the preferred stocks. Okay, regarding the effect of preferred stock, which a preferred stock has on the company. Okay, so first option is a preferred shareholder claims take precedence over the claims of common shareholders in the event of liquidation. Yes, it's correct, because they are preferred shareholders. They are in the priority in case of liquidation. First payment will be made to the preferred shareholder. So this statement is correct 100%. And this is the answer of question. Now look the other requirements. Option B, they're saying non-payment of preferred dividend. Like if you have not paid a preferred dividend, places the firms in default, as does non-payment of interest on debt. Guys, if you will not make payment of interest on debt, yes, you will be in the default, but this is not the scenario for the preferred dividend. Please, even the preferred dividend is not paid, but company will never default due to the non-payment on the preferred stock. Okay, then this is not the option. Okay, this is not the correct. Then C, control of the firm is now shared by the common and preferred shareholders. No, because preferred shareholders, they don't have a voting rights. So that is why control cannot be shared with the preferred stakeholders. Then the firm's after tax profits are shared equally by common and preferred shareholders. No, it's not equally, because when company issue the preferred stock, at that time it's written with the preferred stock what is the amount of dividend you will pay. For example, it may return 4% preferred stock. It means 4% is the amount of dividend, or 8% preferred stock. It means 8% is the amount of dividend, which can be different from the common stock. So this is not the correct. These three statements are incorrect. So only the first statement is the correct. Understood, guys? Okay, guys, I hope so it is clear. So we have studied the topic regarding stocks. So see you in the next class. If you have any question, you can ask. Thank you, guys.